So Cathie Wood and ARK have gone from being the darlings of the stock market to being laughed at by some investors. However, I think it's important to remember that even with their recent difficulties, ARK's main fund has returned 218% profit in the last 5 years. The S&P, on the other hand, just 92%. Now, I'm always preaching to you the importance of thinking in 5-year time horizons, and this is the perfect example. Now, Cathie has recently shared her thoughts on a particular sector of the stock market that us investors, we should be avoiding today. You don't want to miss this. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. Get straight into our first clip.
I know that this fear that inflation at 7%, which is the CPI right now, on a year-over-year basis, is getting embedded into the system because wages are rising and so forth. So what we're seeing on the monetary and fiscal front right now is effectively significant tightening already. On the monetary front, we've seen money growth go from 27% at its peak during the coronavirus, the depths of the coronavirus, to 13% recently. But if you look at it a little more closely and in a shorter term time horizon, we're down to 8% growth on a 3-month basis, 6.5% on a 2-month basis. And we believe that money growth will continue to slow quite significantly, especially if the Fed does raise interest rates. Now, we wouldn't be surprised to see the interest rates go up in March. Many people, after today's employment report, are beginning to think that 50 basis points is the number, that the Fed will basically telegraph that it means business and that it's going to head inflation off at the pass. They may do that. And if they do, however, we think the stars are aligning in such a way that they will get the message very quickly that they don't need to do much more. Another break on them is, a political year, the midterm elections. The Fed does not like to get in the middle of midterm elections, doesn't want to be accused of any political dynamic. So they might want to do the 50 basis points just to say, okay, we're done for a while. Now, what's interesting about the market's reaction to this possibility is that strategists out in our world are now trying to leapfrog each other, saying, okay, I think it's at least 3 more tightenings after that, or 4. I've even heard altogether 7. So the reaction you've seen in the equity market recently is fear, I think, that the Fed is going to go too far, too fast, because as I will go through in a minute, the economy is quite weak. And I think the Fed could overdo it quite quickly. We believe that what's happening is the labor force has been impacted severely by the coronavirus and its variants, and things are still sorting themselves out. But one thing to note is that 5.7% is still lower than that 7% CPI. So real purchasing power is going down right now. We are seeing some indicators that are earlier in the pipeline, like the PPI surprised on the low side at 0.2%. Import prices fell by 1.8%. That would be export prices. Import prices fell by 0.2. So we're beginning to see earlier in the pipeline signals that inflation is going to come down at some point in the future. It may get worse on a year-over-year basis before it gets better. But again, we are very focused on the pipeline. What we are also focused on is that loss of purchasing power is feeding through to retail sales. So retail sales in the all-important December month were down 1.9% on the heels of a 0.2% increase in November, with inflation at 0.4, 0.5, 0.6%. Those numbers, that retail sales number would, in real terms, taking inflation away, have been down 2.5%, and in November also down. So consumption is falling. Equities, as you know, they did move to an all-time high, but the internals of the market last year were not good. They were, I think I mentioned on the last In the Know, that the ratio of new lows to new highs was as high as it's been since 1999. And in 1999, it was the value stocks that were hitting new lows as everyone was racing into the internet. In this last year, it has been our kinds of stocks that were hitting new lows as value stocks were hitting all-time highs. And as you know, the right thing to have done during the late 90s, when that ratio behaved that way, was to move away from the new highs into the new lows. And I think the same is true today. We're also seeing a lot of confusion in the more mature growth area of innovation. Facebook is facing real competition, and TikTok is of course the reason. And it's also under pressure because Apple is not giving it or allowing it to have as much information about users and has put in place new privacy objectives and rules. So Facebook was one of the stocks hitting all-time highs. Now, I have spoken to some really good value investors, who've been doing this all their lives, and asked them, if interest rates were to move into the 2 to 3% range, let's say as measured by the long-term treasury yield, which parts of the market, given where we are now, would be hit? And the answer that I found most interesting, and that I think we've just seen in Facebook, is it would be the more mature growth companies that are facing some competition, and not the super growth companies that are just entering into their exponential growth trajectories. So again, another argument for new growth. Think Amazon early 2000s. If you had put into a dividend discount model Amazon's revenue growth rate for the next 25 years at 20 to 30%, say 20, 25%, which is what happened. Nobody believed it was possible. Then given the way that the cash flow dynamics would have been projected, you would have bought that stock all day long as a value investor. And of course, the returns would have been phenomenal. We are in that same place with truly emerging growth right now. And the private markets know it, because private market valuations have only gone up over the last year. We're writing a paper gathering the data on this right now, but in the last year, as true disruptive innovation strategies depreciated 50% or more, private market, which is which focuses on disruptive innovation, private market valuations seems to have doubled. There's really something wrong with that picture. And I think the private markets have it more right. There's more innovation taking place today than there ever has been in history. And if you take a look at our Big Ideas 2022 webinar, that we spent 5.5 hours, it's up on our site, it's on YouTube, 5.5 hours. Our director of research, Brett Winton, and all of our analysts describing how provocative and profound these changes are going to be. I often muse that during the tech and telecom bubble, I was in the markets at that time, of course. I saw investors, falling all over each other, trying to one-up each other to get a bigger tech position because tech in the indexes had moved to 35%. So we saw many portfolios with 40, 50% tech. Again, they needed to outperform that index. And of course, that was exactly the wrong thing to do. But it was mass psychology. It was a very interesting time. Today, we have the same thing going on in reverse. We have investors shying away, in fact, running for the hills. And the hills in this case are their benchmarks. Everyone needs to get close to that benchmark. And they all look alike. If you look at the top 10 in NASDAQ, top 10 in S&P, the overlap is astonishing. These benchmarks have really, I think, done a disservice to the allocation of capital. But that said, investors are running for the hills when there's volatility, fear around inflation and interest rates. And we think that decision is going to prove to be just as incorrect as the decision to move en masse in the late 90s.
Okay, so the first thing I want to do here is take a balanced approach. As you may know, I'm a big fan of Cathie. However, she has spent much of the past year sharing her concerns about deflation. In reality, we've had serious inflation, and the latest inflation figures only continue to grow. Now, as with all things, we want to try to be impartial, so it's only fair that we acknowledge her mistakes as well as her good predictions. Now, when it comes to inflation moving forwards, Cathie has highlighted that there are factors which could drive inflation figures down in the future. For example, the Fed printing less and less money and then raising interest rates. However, she also notes that inflation, it may continue to get worse before it gets better. So, the real question is, what should you do today? Should you buy innovation stocks that have performed so badly in recent months? Or should you buy value stocks that have already climbed so much in value? Now, this is where most YouTubers bring out the cliches like buy when there is blood in the market or buy the dip. In which case, you should be buying innovation stocks because they have already suffered so much, right? However, applying this idea in reality hasn't always done so well. For example, here is the Japanese stock market over the past 70 years. As you can see, in 1989, it peaked at just under 37,000. 5 years later, it had dropped to 18,000, a 50% fall in 5 years. Now, if investors had bought this dip over the next 14 years, they would have suffered a further 50% drop. In fact, even today, 33 years later, the Japanese stock market still hasn't recovered to its previous all-time high. Okay, so clearly this is an extreme example, and let me be clear, I do not think the same is going to happen with innovation stocks. In fact, other than just about dying industries, you won't find many other examples like this. However, it proves the point that you never know where the bottom is. Nobody knows if innovation stocks have hit their lows or if they'll fall further. But it doesn't really matter. Why? Because trying to predict the peaks or the lows, it's a waste of time. The data clearly shows that nobody can do it with any sort of consistency. So for me, instead, what I do is I simply ask myself, which investments do I want to hold for the next 5 to 10 years? Now, when I look at ARK, I feel the exact same way as I did a year ago. I look at the future and I see many of these companies building it. I also still believe many of these companies will fail. That's just the nature of the market. However, if a few of them succeed in a major way, that will more than compensate for those that do fail. So, what exactly am I doing? Well, in short, I'm doing the exact same thing as I have done over the past year. I am investing the exact same percentage of my portfolio into innovation, around 15 to 20%. I'm not investing more, I'm not investing less. I'm not trying to predict the lows, nor am I panicking. I'm sticking to the same plan that I have had since I very first started investing in innovation. Now, I'm keen to hear your thoughts. Are you sticking with your same plan? Are you buying more? Are you selling? Or have you changed your plan? Let me know in the comments below. Thank you for watching, and I will see you again very soon.